A couple in New Jersey receives a monthly statement. It shows their ATM portfolio generating consistent income. It shows growth. It shows a machine in service. The machine is in a warehouse in Pennsylvania. The keyboard is missing. The hard drive is gone. It has never processed a single transaction. $770 million, raised from 2,700 investors across 7 years. He paid investors $397 million. The math does not work. It was never supposed to. The New Jersey couple does not live in Lancaster County. They have never attended a Mennonite church. They find Paramount Management Group through a podcast on a Tuesday afternoon while driving home from work. They will lose $2 million. We will come back to them. This is not the story of Daryl Heller. You will hear his name exactly once more before the script turns cold. This is the story of the law that let him in and the community that never saw him coming. Lancaster County, Pennsylvania, the wealthiest plane community in America, not wealthy in the way Wall Street uses that word. Wealthy in the way that land, time, and compounding trust make a community wealthy across generations. The Mennonite and Amish communities of Lancaster County have operated in formal lending networks for over 2 centuries. A farmer needs capital to expand. He does not go to a bank. He goes to his pastor. He goes to a trusted neighbor. Money moves through relationships. It always has. This system works precisely because it is built on accountability that no contract can replicate. A man who defaults on a church loan does not just lose money. He loses standing. He loses community. He loses the infrastructure of his daily life. The consequence is total. Daryl Heller is born into the system. His grandfather is a Mennonite pastor. His father is a Mennonite pastor. He grows up inside the architecture of inherited trust, understanding from childhood how it functions, what it requires, and what it will extend without question to the right name. By 2015, Heller is an established figure in Lancaster County's investment community. He operates Paramount Management Group. He has a track record or the appearance of one. He is the son and grandson of men who stood at pulpits and told the truth. When Heller approaches a community, he doesn't introduce himself as an investor. He doesn't need to. His name does it for him. He launches a new offering. He calls it the ATM Income Fund. He says the returns are 25% annually. He says the income is real, tangible, and guaranteed by machines that generate cash around the clock. The machines are real. That part is true. Everything else is not. The offering is structured to appear legitimate. This is intentional. Every layer of the architecture is designed to create the impression of independent oversight while ensuring none exists. Step 1. The investor is approached by a fund manager, a community contact, a podcast, a seminar. The pitch is simple. ATMs generate income every time someone pays a surcharge. Surcharge fees are stable. The machines are tangible assets. This is not the stock market. This is a physical machine that dispenses physical cash. You can see it. You can touch it. Your name is on the bill of sale. Step 2. The investor reviews a legal fundraising document called a private placement memorandum for Prestige Fund, one of 6 fund entities Heller creates. The memorandum describes a 2-company structure. Prestige raises capital from investors. Paramount Management Group acquires and operates the ATMs. 2 companies, 2 functions, the appearance of separation. The memorandum also states, in documented language, that Daryl Heller has absolute control of Paramount. Both companies, 1 man. The separation is cosmetic. Step 3. The investor purchases ATMs, not shares in a fund, physical machines. They receive a bill of sale with a serial number. They receive a management agreement under which Paramount will operate the machine on their behalf and remit monthly income. The investor believes they own a revenue-generating asset. The ATM's Paramount acquires costs as little as $527 each at auction in one documented batch. Paramount pays $52 million for a portfolio of machines and immediately resells them to investors at 4,200% markup. The investors receive serial numbers. They receive bills of sale. They do not receive the machines. What they do receive is access to a dashboard, a portal, a window into a network that looks exactly like what they were promised. What that window actually shows, that comes later. Step 4. Monthly statements arrive. They show income. They show ATMs in service. They show growth. Each quarter, investors receive K-1 forms, the IRS documents that confirm your investments earned income. The IRS receives these forms. The investors file their taxes on income that was never generated by the machines they believe they own. The $397 million paid to investors does not come from ATM surcharges. It comes from the principle of the next wave of investors. Every early investor who receives a return is being paid with capital raised from someone who has not yet discovered the truth. The gap between $28,600,000 in actual income and $397 million in payments is $368,400,000. That gap is not a shortfall. It is the architecture of the fraud. It is the entire structure. It exists on purpose, by design, from the first day the fund opens. There are moments when this stops. When an independent party sees the numbers and the structure and the promises and asks a single question that has no clean answer. These moments exist. They are documented. They are not acted upon. Red flag 1. The impossible return. 25% fixed annual returns from ATM surcharge fees. The average surcharge on an ATM transaction in the United States is $3. The average ATM completes between 6 and 8 transactions per day. If a vending machine earns $2 per day, no one promises it will return 25% annually on a $22,000 purchase price. That will require $5,500 per year from a machine earning $730. Any account with access to the actual transaction logs would see this in an afternoon. No independent audit occurs. The fund operates under a federal rule called Regulation D, which allows private funds to raise money without registering with the SEC, as long as investors qualify as sophisticated. No independent auditor with teeth is required. None is ever appointed. Red flag 2. Single entity total control. The private placement memorandum for Prestige Fund states directly that Daryl Heller has absolute control of Paramount, the fund that collects investor money, and the company that manages investor assets are both controlled by one man. There is no independent custodian. There is no third-party administrator. There is no oversight that Heller himself does not approve. In enforcement history, single controller fund structures appear in more than 80% of confirmed Ponzi cases. This flag has a name. The SEC knows its name. Red flag 3. 10,563 fan machines. In Q3 2023, investor statements report 27,807 ATMs in service across the Paramount network. Paramount's own internal records, the spreadsheets Heller himself reviews, show 17,244 machines. The gap is 10,563 ATMs. These are not missing machines. They are fabricated machines, reported to active investors in real-time financial statements as generating income that no machine is producing. Red flag 4. $60 million in hidden commissions for men Hostetter, Zook, Lehman, Joffrey. They receive a combined $60 million to bring new capital into the fund. None of it is disclosed to investors. None of these men are licensed broker-dealers. They recruit through church networks, agricultural community events, real estate podcasts, hotel conference rooms. They collect $60 million in payments that are not disclosed to the investors they recruit. No regulatory body oversees the sales channel. For red flags, Each one documented, each one visible before the collapse. The law that made all four of these red flags possible, technically, legally possible, has a name. That name comes in Act 7. There is a moment in the investor presentation that is more technically specific than any other act of deception in this case. It is also the most cinematic. Paramount builds an investor portal, a real-time dashboard showing every ATM in the network, its location, its transaction volume, its income generation. Investors can log in. They can see their machines. This is a tangibility the pitch promises. This is a proof. During live presentations to prospective investors, Heller demonstrates the portal. He invites an investor to select any ATM from the database, any machine. At random, the investor points to a location on the map. What the investor does not know, what no investor in that room knows, is what happened before they arrived. Before the presentation begins, a Paramount employee opens a portal and filters the database. The filter removes every underperforming machine, every machine with low transaction volume, every machine generating minimal income. What remains on the screen, what the investor sees and believes, is a complete, unfiltered network, is a curated selection of top performers. The investor picks a machine. It shows excellent income. The investor asks to see another, also excellent. The investor asks to see one more, also excellent. The investor sees a network that performs exactly as promised. The investor signs. This is documented in the SEC complaint. It is not alleged. It is charged. The demonstration is not a miscommunication. It is not optimistic framing. It is not a rounding error. It is a staged performance with a predetermined outcome, rehearsed, filtered, and executed on investors who came in good faith to verify what they were told was true. Meanwhile, the machines that were filtered out, the ones removed before the investor arrived, sit in warehouses, some purchased for $527, some missing keyboards, some missing hard drives, some never connected to a network, some never connected to anything. Serial numbers for these machines appear on investor bills of sale as active, income-generating assets. The investor holding the bill of sale for a specific serial number does not know the machine behind. That number has never processed a single transaction. They received a number. They received a document. They received a statement every month showing that number generating income. The income is fabricated. The machine is broken. The document is real. That combination, a real document backed by a broken machine, is the entire architecture of this fraud in a single sentence. By 2023, the structure requires more incoming capital to sustain the outgoing payments than the sales channel can generate. The fund begins showing stress, not to investors, not in the statements, not in the portal. The stress is visible only in internal accounts, the ones investors never see and regulators never ask for. $3,800,000 moves from investor capital to Heller's personal tax obligations. $1,500,000 moves from investor capital to purchase a beach house. $27 million moves from investor capital to cannabis-related businesses. $92 million moves from investor capital to an unrelated ATM company that Heller also controls. None of this is disclosed to investors. Not one line, not one footnote, not one amended statement. The monthly statements continue to report income. The K-1 forms continue to document earnings. The portal continues to show active machines. Outside, everything looks exactly as it always has. Inside, $124,300,000 in investor capital have been redirected in a single calendar year to obligations, assets, and entities that have nothing to do with the ATMs investors believe they own. Heller's reported personal net worth 1 year before the collapse is $300 million. His investors believe they hold productive assets generating reliable income. 2,700 households, planning retirements, funding educations, making financial decisions, based on statements generated by a system that has been insolvent since the day it was designed. Then, In April 2024, the statement stopped. What Heller does next is not the collapse. It is something worse. April 2024, monthly payments stop. No warning, no letter, no explanation. Investors log into the portal. The dashboard still shows active machines. The network still shows income. The payments have simply stopped. Heller sends a message to investors. He promises a complete buyout of all investor positions by November 2024. A buyer is being arranged. Everyone will be made whole. He asks for patience. There is no buyer. There has never been a buyer. The message is not a miscommunication. It is not an optimistic projection. It is a final instrument of the fraud, deployed not to steal the original investment, but to steal the time investors spend waiting to recover it. While investors wait for the November payment, while they hold their documents and reread their bills of sale and tell their families that a buyer is coming, Paramount begins liquidating the ATM assets. The machines investors believe they own, machines listed on their bills of sale by serial number, are being sold. The proceeds go to Paramount. The investors receive nothing. Heller sends investors purchase agreements. The documents imply a real acquisition is in progress. The documents are fabricated. The grandson of a Mennonite pastor, a man whose grandfather stood at a pulpit and built a life on the trust of his community, sends fabricated acquisition documents to the same community his grandfather served. November 2024 arrives. No payment, no buyer, no communication. December 2024. Paramount closes. February 2025. Bankruptcy filed in the U.S. Bankruptcy Court in Camden, New Jersey. Unsecured creditor claims total $137,400,000. August 2025. The court-appointed bankruptcy examiner delivers his finding. He confirms what the numbers have shown since 2017. This is a Ponzi scheme. September 3rd, 2025. Federal agents arrive at a residence in East Hempfield Township, Pennsylvania. Heller is arrested. The DOJ indictment, U.S. v. Heller, 25 CR 00366, Eastern District of Pennsylvania, charges him with wire fraud, securities fraud, and money laundering. The government has assembled 5,600,000 documents in evidence. Trial is scheduled for April 13th, 2026. Now, we come back to the couple from New Jersey. They do not live in Lancaster County. They have never attended a Mennonite church. They came in through a podcast on a Tuesday afternoon while driving home from work. They are named plaintiffs in civil litigation. Their $2 million is listed as an unsecured claim in the Camden bankruptcy proceedings. Unsecured claims recover last. Sometimes they recover nothing. They came in through a podcast. They leave with worthless paper, backed by broken machines in a warehouse they have never seen and will never visit. The question this case asks, the question every VLTR case asks, is not how one man stole $770 million. That question has a clean answer and a trial date. The harder question, the one that does not have a trial date, is this: how did a regulatory framework allow 2,700 investors to place $770 million into an unregistered fund with a single controller, no independent custodian, no third-party audit, no licensed broker-dealer sales force, and remain entirely outside the perimeter of investor protection law? The answer is one word: Regulation D, a federal rule created in 1982, designed to help small businesses raise capital without the cost of a full SEC registration. Sophisticated investors, institutional capital, complex offerings between parties capable of protecting themselves. That was the design. That was the intent. That is not what happened here. Hostetter, Zook, Lehman, and Joffrey are not licensed broker-dealers. They have no FINRA registration, no federal license to sell investments of any kind to anyone. They recruit through church networks, through agricultural community events, through real estate podcasts, through hotel conference rooms in Lancaster County, Pennsylvania, They collect $60 million in payments that are never disclosed to the investors they recruit. No regulatory body oversees what they do. The SEC oversees the securities. Nobody oversees the community. The SEC's own Office of Inspector General has documented, across multiple enforcement reviews, that Regulation D creates structural blind spots in communities with low financial literacy infrastructure and high informal trust networks. The report exists, the finding exists, the blind spot exists, and it is not theoretical. It is 2,700 households. It is $770 million. It is a beach house and a cannabis business, and a fabricated portal, and a bill of sale for a machine with no hard drive, backed by a regulatory exemption that was never designed to reach this far, and has never been updated to stop it from doing so. The next fund using this architecture is not coming. It is already open. Right now, somewhere in the United States, a man is standing in a hotel conference room. He has a pitch deck. He has a portal. He has a private placement memorandum that is technically, legally compliant. And he is talking to a room full of people who trust him for exactly the same reason 2,700 households trusted Daryl Heller. Because someone they know introduced him. 2,700 households trusted a man whose grandfather stood at a pulpit. The law that should have protected them was never designed to reach that far. He didn't steal from the Amish. He stole what they trusted most. The SEC oversees the securities. Nobody oversees the community. One question this case does not answer. For men collected $60 million to recruit investors into this fund. Hostetter, Zook, Lehman, Joffrey, none of them are named in the criminal indictment. Not yet. If this case made you ask how your own investments are structured, that question is worth answering. Every fraud ValtR documents leaves the same architecture behind. A single controller, a compliant document, a portal that shows exactly what you need to see. The next case on this channel breaks down a fraud that used the same architecture inside a system most people trust without question and survive for longer than this one did. Subscribe. The next file opens next week.